Have you ever wondered why rich people aren't afraid of debt? While most people struggle to pay off personal loans or credit cards, rich people use debt as a tool to create more wealth. Yes, you heard that right. For them, debt is leverage that allows them to increase their finances to levels most can only dream of. Today, I'm going to reveal the 5 specific ways rich people use debt to make money. Each strategy we'll see can help you change your perspective and, most importantly, improve your financial results. Stay until the end, because the last technique is so powerful that it can change your life if you apply it intelligently. Ready? Let's start right now. The number one mistake people make when going into debt is using loans to buy things that lose value over time. First, they use debt to acquire assets that generate income. Rich people do just the opposite. They use debt to acquire income-producing assets. What kind of assets? Real estate, businesses, or even stock market investments. This approach is fundamental to building wealth sustainably. Let's talk about real estate. Imagine an investor buys an apartment building for $1 million. Instead of using their own money, they take out a bank loan covering 80% of the price. Now the tenants pay rent, and that monthly income not only covers the mortgage payments, but also generates extra cash flow. This flow is a source of passive income that doesn't require constant work. The magic is that other people are paying off the debt. As the property increases in value over time, the investor sees their wealth grow without having to use all their capital. This is one of the secrets behind the famous phrase, "Let your money work for you." Let's think about a real-life example. Grant Cardone, a real estate entrepreneur and writer, started by buying small apartment buildings financed with loans. Today, he manages a multi-million-dollar property portfolio, almost all purchased using debt strategically. His monthly cash flow far exceeds the cost of the loans, continuously generating wealth. The difference between good debt and bad debt is simple. Good debt generates income for you or allows you to buy something that will increase in value, while bad debt just empties your pockets. Think about which of these you are using in your life. But real estate isn't the only way to win with debt. The next strategy is just as powerful, but applies to much more dynamic investments. Leverage is a word you hear a lot in the world of finance, but it's not always clear what it means or how to use it. Second, leverage in high-yield investments. Basically, it refers to using borrowed money to increase the potential return on an investment. This is where the rich really show their mastery. Imagine you have $50,000 and decide to invest it in stocks. If the market goes up 10%, your profit is $5,000. But what if you could borrow to buy more stock? Suppose a bank or brokerage lends you another $50,000, allowing you to buy $100,000 in stock instead of $50,000. If the market goes up the same 10%, your profit is now $10,000 instead of $5,000. This is where leverage works wonders. By using borrowed money, you've doubled your profits. However, it's important to keep in mind that this power amplifies both gains and losses. If the market were to go down 10%, your losses would also be greater. That's why only experienced investors with solid knowledge take risks with this strategy. A practical case of leverage. Successful entrepreneurs constantly use leverage to grow their businesses. Let's take Elon Musk as an example. When Tesla needed capital to expand, it turned to financing instead of selling its own shares. Why? Because the cost of the loans were lower than the expected return from the company's growth. This type of decision is what separates the rich from those who see debt as something exclusively negative. Golden rule of leverage. The secret to success with leverage is simple. Make sure the rate of return on your investment is much higher than the cost of the loan. For example, if you're paying 5% interest, but your investment generates 12% annually, you're earning a positive margin of 7%. This margin is the key to building wealth using money that isn't yours. But the rich don't just seek higher returns. They also focus on reducing the cost of their current debts. That brings us to the next strategy. Rich people never settle for the same loan terms if they can improve them. Third, strategic refinancing to reduce costs and free up capital. One of the most effective ways to save thousands of dollars is by refinancing debts at lower interest rates or renegotiating more favorable terms. Imagine this scenario. You have a $300,000 mortgage at a 6% interest rate. This means you're paying thousands of dollars just in interest every year. If market rates drop to 4%, refinancing your mortgage could save you more than $5,000 a year. Now think about what you could do with that $5,000. Invest in another asset, create an emergency fund, or accelerate the payment of other debts. Rich people know that every dollar counts, and they take advantage of every opportunity to optimize their expenses. Another smart use of refinancing is to take money out of an asset that has increased in value without having to sell it. If your house or commercial property has gone up in price, you can refinance for a larger amount than the current mortgage balance. This extra money can be invested in new opportunities, creating a snowball effect on your investments. The key here is to use that money for income-producing assets, not for consumer spending. But saving money on interest is only part of the game. Rich people also know how to use tax laws to their advantage by using debt. Let's see how. One of the best-kept secrets of the wealthy is how they use debt to reduce their tax bill. Fourth, tax benefit of deductible interest. In many countries, the interest on certain debts, such as mortgages on investment properties or business loans, is tax deductible. This allows them to lower their taxable income, pay less in taxes, and keep more money. Suppose you have an investment property and pay $15,000 a year in mortgage interest. You can deduct this amount from your gross income. If you're in a 30% tax bracket, you're saving $4,500 just in taxes. It's like the government is subsidizing your investment, encouraging you to go into debt to create wealth. Rich people understand how to play this tax game to their advantage and make sure to maximize every possible deduction. Business owners also deduct the interest on loans for their businesses. Imagine you take out a loan to buy machinery or expand your company. Interest payments are not just an obligation, but they also reduce your taxes, making the real cost of the loan much lower. And now, we come to a tool that we all use, but few know how to manage well: credit cards. Credit cards have a bad reputation, but the truth is, when used wisely, they can be a powerful ally in your finances. Rich people don't use credit cards to spend what they don't have. Instead, they use them to optimize their cash flow and earn rewards. They pay off all balances on time and never pay interest. This way, they maximize rewards like airline miles, travel points, or cashback on everyday purchases. Basically, the money they would have spent anyway works for them, generating additional benefits. In the business world, entrepreneurs use lines of credit to cover short-term, day-to-day expenses. For example, if a supplier offers a discount for paying within 10 days, but the cash flow isn't sufficient, a line of credit can cover that payment. This allows them to take advantage of the discount without touching working capital. Fifth, credit cards as a cash flow tool. Debt is neither good nor bad in itself, it's simply a tool. The key is how you use it. Rich people understand that debt can be a very powerful lever to create wealth, as long as you use it strategically and responsibly. Buying income-generating assets, using leverage to multiply returns, refinancing to optimize costs, benefiting from tax deductions, and using credit cards as a financial tool are 5 ways you can change your relationship with debt. The difference between the rich and everyone else is not the absence of debt, but how they manage and master the use of debt to their advantage. If you apply these strategies, you can begin to transform your financial situation. Now I want to hear from you. Which of these strategies do you find most interesting? Are you already applying any of them? Leave it in the comments. And if you like this content, don't forget to subscribe, like, and turn on notifications so you don't miss out on more life-changing financial strategies. Remember, knowledge is power, but only if you put it into practice. See you in the next video.